Today, we're going to learn how to record adjusting journal entries in the general journal. Not a very long exercise, and what you would be seeing and learning today is how to record depreciation in the journal entry, prepaid and accrued expenses, accrued income, bad debts, and provision for doubtful debts. Now we have come across all these items before, and it will not be difficult for us to understand how to do this, right? So the lesson would be a very brief one, and then you'll go back to it. Okay, that noise coming from out the window there. Let's just let that vehicle pass. All right, so we continue. After the lesson, you will go back to the classroom, look at the video, look at the presentation again, and then you will work the exercise, okay? We want to look at how we record these items in the general journal. They are all adjusting journal entries. Now, how the process is usually done by after you finish at the end of the year, you will go through your books and see which items need adjusting, and you will make a list of them like I have here, and then you will write the entries in the general journal to correct or to adjust those balances. And after you finish that, you will post the entries to the ledger accounts and then adjust the trial balance. Okay, let's read through this before we start. Right, Twin Company has the following in his books at the end of the financial year, 30th of June 2020. We have depreciation on equipment, 10,800. Depreciation on motor vehicles, 2,500. Expenses owing, salaries and wages, 15,000, and he paid 100,000. So he's not owing the 100,000, only the 15,000. Electricity, 3,000, and he paid 45,000. Accrued income, interest on the bank balance of 1,500, due from D. Arjun, rent of 500. We have prepaid expenses, insurance 2,000, stationery supplies on hand 500. So in addition to that, we have the following accounts receivable were deemed to be bad. Charles 500 and Hussein 300. And it is prudent to make a 2% provision for bad debts or doubtful debts. His accounts receivable, excluding the bad debts, is 10,500. So it would be 2% of the 10,500, that is $210, right? I will not be coming back to this page, so I will just be going through it. Okay, so let's get into it. First, you head up properly. Twin Company General Journal for the year ending 30th of June 2020. And we make the first entry for the depreciation. We have the date. Profit and loss account is debited with 10,800, and provision for depreciation on equipment is credited with 10,800. Okay. This is the normal format for depreciation entry, debit profit and loss, credit depreciation provision for that item, right? And we write in the narrative to record depreciation on equipment for the year ended 30th of June 2020. We do the same with the motor vehicles, profit and loss account, 2,500. Provision for depreciation on motor vehicles, 2,500. To record depreciation on motor vehicles for the year ending 30th of June 2020. Now, we could have joined both of these entries together as well, and that would also be acceptable. We add the two debits for the profit and loss together, and we provision will have two separate credits, right? So you'll have one debit, two credits equaling that one debit, right? And of course, the narrative will say depreciation on equipment and on motor vehicles. Okay, so that's a compound entry. You could have made that as well. The next one is a compound entry, so you can see how to do it. The two accrued expenses can be added together. So we have salaries and wages, 15,000, electricity, 3,000, and then we credit accrued expenses with the total for 18,000. And of course, we could have done that with these two separated. Debit this for 15, credit here for 15. Then debit this for 15, sorry, for 3, and credit here for 3. Okay? And another name for accrued expenses, we remember that to be expenses owing. And our narrative to record expenses owing at the year end 30th of June 2020. Okay, notice again the indentation of the credit here. Okay, you start it as though you start in a new paragraph, right? Now all the entries would not fit on this page, so I will go into the other slide and the other pages, but you should know that your general journal is one long page that all the entries should fit on. Okay, I'll bring over the heading. And the next item is the accrued income, which is the opposite of the accrued expenses. So we'll debit it this time, accrued income, and we can add the two together again. Notice the accounts here is interest received, not receivable. Interest receivable, right, is an asset, right? Interest received is an income. Okay, rent received, same thing. Notice again the indentation for the credits, the narrative to record interest and rent due for the year ended 30th of June 2020. Next item is the prepaid expenses. We debit prepaid expenses. It was something that we own. It's an asset, and we credit the two expense account with the amounts, and we make the general journal entry again to record. Sorry, we make the narrative so that another accountant who is reading this must be able to tell what we have done without asking us, right? To record prepaid expenses for the year ended 30th of June 2020. So the accounts that are prepaid, we will credit it, and we will debit an asset account, prepaid expenses with the 2,500. Next item is the bad debts, and we write off the two bad debts for Charles and Hussein by crediting their accounts and debiting the bad debts accounts in the income statement with the total. Again, we could have done it separately, and we would have had two debits in the bad debts account, but it is the same one account, so we could add them together and then just credit the customer's account. These people accounts will be stamped closed, and we will not trade with them again, right? To write off debts as bad is the narrative. We move on to the provision for bad debts. We calculated the amount as being 210, 2% of 10,500. We debit the profit and loss account with 210, and we credit the provision for bad debt with 210. The entry is always the same. The narrative, however, is not always the same. When you're doing it for the first time, you're creating the provision, and you say we create a provision for doubtful accounts receivable at 30th of 6, 2020, and we credit the provision for bad debt, or we could call it provision for doubtful accounts, and that would have created the provision. In subsequent years, when we need to either increase this provision or decrease it, we will make another adjustment in similar fashion. Okay, so that would bring us to the end of that lesson. I have here some transactions, some adjustments that you will attempt, all right? And we just read through them before you get into it. Thomas Company has the following in their books at the end of the financial year end, 31st March 2020. Depreciation on machinery, 20,000. Depreciation on motor vehicles, 12,500. You have your expenses owing and the amount paid during the year, the rates of 6,000, and how much was paid during the year again. Accrued income, 1,500 for rent. Prepaid expenses, we bought stationery supplies for 5,000, and we used some of it during the year. At the end of the year, the stock is 300, so this is your prepaid amount here. And then we have some accounts receivable that are bad, Macoon and Williams for those amounts. Make a 5% provision for the doubtful debts of 18,000. Right, the 18,000 excludes these two bad debts here.